Here is a simple and basic fact. You close short options to roll or to get rid of non-beneficial risk. And if all options on that stock are totally illiquid, then you're probably not going to be able to roll anyway. And that answers half your question right there. So as far as taking off risk on the final day in the life of an option, does it really end up being worth it to buy some of these illiquid options back at a nickel or a dime on that final day when they're so far out of the money that they're very, very unlikely to get filled? Well, in these cases, I would say no. It doesn't help very much, and it's basically throwing money away. So there's kind of a lot to think about here.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 57, GTCs and Birds and Bees. But before we jump in today, let's talk about how you can make many, many friends today. You know the best way to make friends? It's to share something with them that can make them wealthier. It's true. Studies prove it. So the best thing you can do today is to tell someone about the Wealth Building with Options podcast. That, and of course, to become a paid subscriber. When you're a paid subscriber, you get video extra podcast episodes, so you can get hands-on video training on things we talk about on the show, subscriber-only posts where I'll drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on options income trades and much more. And the best part is, your paid subscription helps keep this show on the air. To become a paid subscriber, just go to the Wealth Building with Options Substack page and sign up. The shortcut to that page is wealthbuildingpodcast.com. That's wealthbuildingpodcast.com. And choose a monthly or annual subscription. Or for the best value, become an all-in wealth builder and get everything I mentioned, plus our Friday group coaching, our Smart Income video class, which alone is valued at more than the subscription price, and get on the wait list to get a signed copy of my new book, Build Consistent Wealth with Options, scheduled for release on April 28th of 2026. We have a few more important topics to share today before we move the show out of chapter 14, which is what we've been talking a lot about over the past few weeks. And I could probably do several more episodes on just the liquidity part alone. And we'll likely revisit some key tips later on execution and things. But we must move on to still other important topics after today's show. Today, we start out talking about GTC orders, or good till cancel orders. Then we'll cover gap risk and then liquidity. And as much as I'm a man of many stories and like to start out each episode with something fun and relatable, I think it better to weave these stories into the different segments today, as each is relevant to the specific segment. And so we go. My way of doing things as a trader has changed over the years, and that's normal, right? If you don't change, if you stay still, well, you can't get better, right? And so that's how it is with my trading. That's how it is with my everything. I like to continue to improve. But now, how it used to be is I never used to use good till cancel orders. And someone asked me once, one of our market taker mentoring student traders asked me once, well, Dan, why don't you use good till cancel orders? And I thought to myself, and I said, because I'm afraid I might forget that I have the order in and then put in another order and end up getting double filled or something like that. But you could make the same argument either way. And I did make that same argument to myself, the opposite argument, that I could also miss an opportunity or forget that I have a position on or something that I need to watch and maybe miss a fill that way too, which is the lesser of the two evils. And so since then, I use good till cancel orders like crazy, like every time I put on a trade. If I were trading a covered call or cash secured put with decent liquidity, as soon as my order to open the new position executes and I have the position on, what I do is I immediately put in a good till cancel to close the position at 3 cents. Now, again, that's when we're talking about something in the top tier of liquidity, your SPYs, your Apples, your Amazons, etc. If I'm trading a covered call or cash secured put that's less liquid, or if they trade with nickel increments as the smallest price movement, then I'll put in like a 5 cent bid, good till canceled. Or if the price of the option is a little more than that, like usually if the option is more than $2 or so, sometimes I'll even put in a 10-cent good till cancel bid. In liquid option classes, at some point, I usually end up canceling that bid. And instead of just waiting for it to fill to close the position, I cancel the bid and then I roll that option. I put in a new order to roll. So why do I end up putting the good till cancel to close bid in the first place if I'm planning to really roll it anyway? Well, it's because sometimes a surprise move could happen and the option could get way out of the money just overnight and open up the next morning and I get filled. That happened to me today and yesterday, as far as the time when I was actually recording this. And sometimes even in the less liquid ones, well, you never know what's going to happen. Sometimes the liquidity evaporates and somebody just happens to want to sell it, and it's my bid that happens to be there in front of the market makers. And sometimes you end up getting a lucky fill. Look, the order can't get filled if it's not working. And in those cases where that GTC order does get hit and I end up buying it back at 3 cents or a nickel or a dime, then what do? Well, I sell another call or put and I continue the cycle as soon as I notice it. It's basically like rolling, but just I close it with the GTC and then I sell another one. So I do it on legs, as they say. Now, if the good till cancel order does not fill, then I'm stuck deciding whether to wait or to pay up on something that's basically worthless, right? And this is really a problem when it comes to the less liquid options, where it's no bid at a dime or something like that. How do I know what to do? How do I know if I should pay up and pay 15 or 20 cents for it, or wait until my 5 or 10 cent order fills, or cancel it and let it expire? How do I know? Well, the theta comparison helps guide the decision. And this is really important. This is one of the best takeaways that I can give you. But paying up to close illiquid options done many times over can really drag on the overall long-term profitability of the strategy. Timing comes into play. It's especially key to monitor these sorts of positions on expiration day for sure. Here is a simple and basic fact. You close short options to roll or to get rid of non-beneficial risk. And if all options on that stock are totally illiquid, then you're probably not going to be able to roll anyway. And that answers half your question right there. So as far as taking off risk on the final day in the life of an option, does it really end up being worth it to buy some of these illiquid options back at a nickel or a dime on that final day when they're so far out of the money that they're very, very unlikely to get filled? Well, in these cases, I would say no. It doesn't help very much, and it's basically throwing money away. So there's kind of a lot to think about here. As the likelihood of expiring increases, it starts to be a better play just to cancel the GTC bids and let those puppies expire instead of overpaying for them. Take that theta, because that's basically what it is. Canceling your GTC order is getting that in theta instead of paying it to close it. Within the money options, the bid ask can sometimes be massively wide, and that leads to much more of an overpayment on closing than just 5 or 10 cents. Bigger delta options tend to have wider bid ask spreads, especially in more illiquid names, because there's reason for it. Market makers have more execution risk on shares of stock used to hedge. So let's talk about it. And like I said, I'm especially talking about in the money options. For market makers to lock in a theoretical profit, like we've talked about on previous shows, when they buy a put at a particular specific price, well, they believe that they have a theoretical edge because they're buying that below a specific theoretical value that is based off a very specific price in the underlying. So if they pay this for the put, they have to pay this for the stock, or below there would be great too, but you can't count on buying below it. But if they buy above it, that can ruin their trade. That can take away all their theoretical edge and turn a winning trade into a losing trade. Same thing for when they buy a call, right? And I'm saying they buy because we're on the sell side when we enter a opening order. When they buy a call, then market makers have to sell shares of stock to hedge. And the price needed on the stock is contingent upon the price they bought the call. That is, if they want to lock in a theoretical profit. And they do. That's their whole job. The bigger the delta, the more shares needed to hedge. And that means more risk of the stock price moving when the market maker needs to trade it. If the stock price moves up when they need to buy or down when they need to sell, that's risk, and that can happen. More risk always means the need for more reward. For market makers, profit results from buying the options bids and selling the options offers. And then they just lock in that theoretical value by hedging with the underlying. The immediate risk is the stock moving and thus not getting needed hedge prices. Logically, bigger delta equals wider bid-ask spreads. Rolling is typically not a possibility when it comes to illiquid, especially illiquid in the money options. Rolling from an in the money option to an at or out of the money option, well, that spread, because that is a spread, a roll is a spread, right? That ends up being a bigger delta spread because you're closing one with a small delta and opening one with a new delta. And I'm talking from the market maker's perspective, but even for not the market maker. And so when you propose this deal to the market maker, right? Because that's basically what you're doing when you enter an order that's not trading on their bid and or offer. When I put in a mid-market order for a roll to close in the money and open it out of the money or vice versa, well, because that has a bigger delta, the market makers are often not willing to compromise. So moral to the story here is, there's a lot to think about. And the more you understand the mechanics of market makers, the better. Now let's shift gears away from market makers for a moment and talk about what I described before. We briefly touched on this a couple episodes ago, the overpaying versus gap risk trade-off. In the case of illiquid in the money options, trying to force getting out of the trade by paying the offer, that ends up being an absolute definite overpayment. But options expire with no time value left. So, like I said before, you're basically getting theta. Letting an option expire is kind of like buying it back at zero, getting 100% theta. And getting assigned, well, that takes all the time value down to zero as well. You get the long or short stock at parity, the strike price, with no time value. So in either case, letting it expire or accepting assignment means you're not overpaying, because overpaying has everything to do with time value. What it really means is you're getting the absolute best price possible. But there's a but. But letting expiration or assignment take place can add weekend volatility gap risk for wheel traders. Typically, when we roll, we wheel traders roll by buying one option to close and selling to open the new option as one single trade. We are trading a spread. Buy one, sell the other one, that's a spread. And when we do, we know that we can buy the one option at this particular price and sell the other at that particular price. But if the option is held until expiration and expires or is assigned, well, you don't really know what price you can get on the new option that you were planning to sell as part of that spread to replace the one that you're letting expire instead of buying. So when Monday morning rolls around, the stock may have gapped higher or lower. That means the option the investor would have wanted to sell will be trading at a better or a worse price. This is called gap risk. Gap risk is the risk of the stock gapping overnight or over the weekend in this case, leading to a beneficial or detrimental price change in the price of the option. It's an unwanted wild card risk. It is strictly adding volatility. When rolling illiquid options, investors basically end up with two choices: rolling and likely paying too much to close the one option, but knowing the price they can sell the other, and that might be a bad price too, or waiting for expiration and exiting the one option with no time value, but having gap risk over the weekend and accepting that volatility and that uncertainty on the price of the option that they need to sell. The loss from overpaying is certain. The benefit or detriment from gap risk is random. And so as an option trader, we think in terms of a log normal distribution of prices. So we assume basically a 50-50 chance of a stock being higher or lower, especially if we're talking expiration day, with a very, very, very slight bias for this one-day move for the stock being higher the next trading session. But that's basically theoretical. It's basically 50-50. So the logical way, like a game theory person would think about this, would be you should accept gap risk. Why? Because if we overpay to close this illiquid option, pay up to 20 cents for something that's going to be worth 0 cents in a few days, at least the time value portion of it, we know that we're overpaying by that big amount. If we let it expire or get assigned, well, half the time it's going to go against us and half the time it's going to go our way. And in the average, if we do this trade 1,000 times, it should work out in the wash even money. It's just that on any one individual trade, we get that volatility. And sometimes it's going to suck and sometimes we're going to feel super lucky. Now, there are some caveats to this, like maybe ex-dividend dates or tax law considerations, or maybe some other one-off scenarios that might come into play. But as a general rule, overpaying adds a certain drain on returns when using this system. Accepting gap risk simply adds volatility of returns. Otherwise, it's assumed to be return neutral. And so there was one time when my kids were little. I forget if I don't think I told this story on the show before. If I did, yeah, it's a good story. It'll be good to jog your memory. One time, a long time ago, we took our kids to a water park for the weekend. And, this was when I was living in the city of Chicago and hanging out with 2,000s of my closest friends on the trading floor. And so it was one of these things where, like, anywhere I went, I would run into somebody I know. And we drove to this water park that was like 50 miles away from my house. And wouldn't you know it, in walks through the door a trader that I know from the SPX pit. Now, the thing about the SPX pit, especially back in these days before there were weekly and daily contracts, is that they're AM settled and cash settled. And so it's kind of a weird thing for people who only trade stock options. With the stock option, the bell rings at the end of the day Friday and trading stops and you decide what to assign or take assignment on. And usually it's just you let the OCC use the 1 penny rule. If it's in the money by a penny, it gets signed. If it's not, it doesn't. But the SPX is different. How the SPX works is when the bell rings on Thursday, it stops trading. But whether the option is in or out of the money is dependent on the price of SPX on the opening rotation. So you have this natural overnight risk that comes into play. Well, normally that's fine. And in the long run, everything kind of works out in the wash. But this was one of those times where there was a big, humongous gap. I forget. I think it was probably lower. And this guy was a market maker in the SPX pit. And I was like, hey, Joe or Fred or whatever his name was, I forget. You seem kind of down. What's going on? He's like, did you see what happened on Friday? Oh my gosh. And I was like, yeah, so what? I was like, well, I was short a bunch of these puts that I thought there was no way they could be in the money. And SPX gapped down so much that I lost like $100,000 or something. I think it was more than that. It was like happy that he didn't get taken out of business that day. So yeah, every once in a while, you can really take it on the chin or get super lucky and have a great day. So it seems like a gamble on any particular trade, but in the long run, it should work out in the wash. Now let's kind of back up a little bit and talk again about liquidity. And liquidity is a funny thing. Liquidity providers are super important. If there weren't market makers or dealers providing liquidity, the market just could not exist. But mere mortals also can provide liquidity as well. And this process of providing liquidity is not really intentional. It's more a byproduct, really. It's like when bees fly around to different flowers, like they pollinate, because they get some pollen on their feet or legs or whatever, and then they go to a different flower, and then that pollen goes into the stamen. Well, the bees aren't trying to pollinate flowers. They're just trying to get that sweet, sweet nectar. The pollen, that's just sort of a byproduct. I mean, geez, it like keeps the planet alive, but, they're not trying to do it. And that's kind of what it's like with market makers. Market makers trade to make a profit, but in the process, they're providing liquidity. And I don't know if you've ever thought about how this all works or anything, but each stock has the same market maker today as it did yesterday, as it did last week, as it did last month, as it did last year. The same market makers make markets in the same stocks every day. That's sort of their, well, they call it their book sometimes. So it's my observation that different stocks options have different personalities. The options listed on, for example, Apple might trade with a different feel, if you will, from options listed on Citigroup. One option class might be easier to middle than another. One may be hard to get a decent fill on spreads. One might never trade at all unless it's on the bid or the offer. The market makers might even lower their bid in some stock options if you offer between the bid and ask. The reason for this personality, as I call it, and I think that's a really good word, is because a specialist or a designated primary market maker, that's what they call them on the SIBO, who is a human, makes the decision on how to handle what they will buy and what they'll sell on different option classes. If in our example, Apple and Citigroup have different specialists, well, each of them are going to handle risk differently. Even though much of the mechanics are automated, it's still a human setting the parameters of that automation. Imagine a volatile stock with illiquid options, like we were talking about throughout this whole show, and it traded in a pretty large range, okay? The stock traded from, say, $290 to $360 over a several-month period. And it just sort of went up and down between those two prices. With such high realized volatility in the underlying, the options implied volatility, it's going to be really high too. So the option premiums are going to be expensive. In this example, let's say that the historical volatility is 40.1 and the implied volatility is 42.3. Okay. Selling overpriced options always works better, but it's not necessarily always required in cases of volatile stocks with illiquid options. Okay? Hear me out. This is true for two reasons. You should care more about what the trade is worth to you rather than what the market values it. And the other reason is in cases where the bid-ask spread, the market for that option is really wide, the theoretical value might not be the exact middle on your retail trading platform screen. And thus, numbers derived from the option value, like implied volatility and delta, are not really as reliable as they would be if you're a professional using professional modeling software. So now imagine that said stock is at $3.10. So imagine you believe that the recent range is going to hold. You plan to sell a 380 strike call, adding a little bit of wiggle room above the top of the recent range, okay, which again was $360. So the bid ask spread for the 23-day to expiration call is going to be, let's say, $2.55 bid at $6.80. So a really, really wide mark. All right. Now assume that there's no volume on the day yet in that strike, but there is some open interest, and it's small, and it's very dispersed among the different strikes, which indicates that there's at least some retail interest in these options, but maybe not much professional interest. How does the investor minimize slippage on both sides of this, getting in and getting out? How might this play out on the position entry? Let's start there. Well, assume you place the limit price for the order a little under the middle of the market. So what did I say? That was $2.55 at $6.80. So imagine you place like a $4.50 offer, a little closer to the bid than the offer. You'd be giving up edge, but why? Well, because you would do that if you think the trade is sound at that price based on the criteria that you analyze the trade, which is going to be, as you recall, some of the criteria that we've used and talked about on the show. That should be based on the annualized return, presuming you have the skate objective. And in this case, you could infer that you do have the skate objective because we're talking about setting the strike above resistance at $380 when the top of the range is $360. We're getting that added wiggle room. So that's a skate objective trade. And so we want to base our logic on annualized return. With no volume yet today and very little open interest, if this order gets filled, it's only going to get filled in one of two situations. Situation one, there's another retail out there who in this case happens to want to buy that call and notices the tighter bid-ask spread, which would now be $2.55 at $4.50, showing your offer, right? And they would probably notice, oh, there's just one contract on the offer, so this market's probably a lot wider. The market maker's market is a lot wider. This must be some other retail trader. Hey, here's an opportunity to buy this call and not give up as much edge to the market maker. So it's your retail offer trading with their retail bid, and you both basically kind of win in that case. Now, that doesn't happen that often. The other scenario would be more common. The stock ends up rising and the market maker's bid goes from $2.55 up to your offer of $4.50. Or maybe it starts getting close to there and they say, oh, hey, my bid is $4. There's that $4.50 offer. I'm just going to buy that because it's got enough edge. I'm going to step up and take it. And that is the way more common scenario. Now, let's kind of just break this apart for a second. In the case of trading with another retail trader, you would actually, and the other trader would actually be creating liquidity. So that means not taking the liquidity from the traditional liquidity provider, the market maker or dealer, but you actually tightened up the ask by adding an offer lower than the market maker's offer. And when a trader trades with your offer instead of the market maker's, well, that trader is taking your liquidity or providing liquidity to you. You can look at it either way, really. Now, in the case where the stock goes up and the market maker's bid gets higher, you're certainly giving up edge to the market makers, or maybe even a random retail trader too. Who knows? Probably the market maker though. And that's okay to accept giving up slippage to get into these illiquid options. It's kind of, if you think about it, irrelevant, because what you really care about is what that trade is worth to you. If it's got a good annualized return to you, who cares? I mean, the market maker is like, yeah, this is great because it's got lots of edge to me. And you're like, yeah, this is great because it's got an awesome annualized return to me. And it really, truly is a win-win. And that about wraps it up for this show. But before you go, make sure you're subscribed on your favorite podcast platform, whether it's Spotify, Apple Podcasts, or whatever it may be. And if you would be so kind as to leave a comment, I would surely appreciate it. Let me know what you like or what you'd like to hear more of. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read Characteristics and Risks of Standardized Options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.